Hi, and welcome back to Slot Leader, a Cardano finance podcast where we try to bridge the gap between the world of finance and the world of blockchain technology. I'm your host, Umed Saidov, and in today's episode, we'll be focusing on pension funds. My guest is Dean McClelland. He is the CEO of TontineTrust, a company that is bringing back an age-old or maybe 200-year-old construct in order to solve a longevity problem in the pension fund industry, while at the same time leveraging blockchain technology to augment the transparency in this industry. Our interview is a fascinating one, and we explore a lot of different angles and a lot of different challenges and opportunities in this sector, and see how blockchain technology could augment and could supplement the rollout of new products globally, especially in countries where pensions as a construct do not exist. I hope you liked the interview. We had a lot of interesting questions answered, and I'm hopeful, to be honest, that Dean McClelland will come back to the Cardano Foundation or Cardano Treasury at some point to request funds in order to build a dApp on our ecosystem. So without further ado, here is the interview. If you are a Cardano stakeholder and you would like to support Slot Leader, one of the ways you could do that is by staking your ADA with skylightpool.com. We've been running our pools since the early days of ITN, and we've amassed an enormous amount of experience and generated great rewards for our stakeholders. We run two pools with tickers Sky and Sky2, and we offer great benefits also. For those of you who have been staking with us since the beginning, I would like to thank you. For those of you who are thinking about joining us, please consider that we will create additional content and analytical reports and exclusive AMAs with me once we build these functionalities and features on pooltool.io. As always, I would like to remind our viewers and listeners that Slot Leader is an educational podcast, and as such, we do not provide investment, financial, tax, or legal advice. I realized that I may have jumped the gun when I said without further ado, because we have the news section to cover before we get to that interview. I'm going to be very quick on this one. The first news that I would like to cover is the decision by Tesla to invest $1.5 billion worth of United States dollars into Bitcoin. That constitutes about 10% of their reserves, as far as I could tell from reading the reports, and it cements Bitcoin's value proposition as a store of value. I think this kind of increased adoption by the corporates of a digital asset bodes really well for the entire ecosystem as it basically enters the mainstream. Now we are seeing Bitcoin being accepted as the store of value increasingly, and we might see other tokens getting more attention, or the industry itself getting more attention from the holders of capital that would like to deploy it somewhere to produce returns and deploy it productively. The second piece of news I would like to cover is with regards to the Cardano community and what's happening in Cardano, and that is the transition to Mary. We have successfully started the transition into Mary. For those of you who don't know, Mary is the first stage in Goguen where we will have the token capabilities, and in these tokens will be governed by scripts, and they will be treated on a consensus level as this, in the same way that ADA token is the native currency, ADA is being treated, and it is a monumental sort of achievement in the Cardano community, and it will allow projects to start migrating into Cardano to save costs. I would like to welcome our guest today. His name is Dean McClelland, and he is the CEO of TontineTrust. Let's get it started. Can you tell us a little bit about yourself and what TontineTrust is all about?
Hi, Ahmed. Great to be on. Obviously, I'd heard a lot about you over the last few months, even better to meet you in person. I think you were thinking, who am I? What are we about? My background is I started coding as a teenager. I bought a little machine, started writing programs, wrote a car racing game, an early version of Tinder, stuff like that. But I didn't know anybody else in the programming space. So I got persuaded because I was good at math to go into finance. So I spent most of my career in finance, investment banking, structured finance, but always have been a techie. And a few years ago, we got exposed to a problem, and I thought I need to go and find a solution for it. And this is kind of the origin of TontineTrust.
So that brings me to my question. Why did you create TontineTrust?
Well, essentially what I found out, what I discovered, it's almost 4 years ago now, which is scary to think about, that I was having a conversation with my mother, and we were talking about her retirement and her friends in the golf club. And to cut a long story short, it turns out that they tend to spend the majority of their retirement worrying about spending money. In the good old days, everybody had a fixed pension for life that went up faster than inflation. But somewhere around the 1980s, corporations and governments started to realize this is a bit of a problem, that they can't afford to keep offering this. So they switched to this new pension system where essentially you don't have a pension, you just have a savings account. And when you reach retirement, it's your job to figure out how to make that money last for the rest of your life. And if the pension industry couldn't get the math right, what is the possibility that every man and woman in the street in their old age can now get that math right on their own? So it's a very stressful problem and it needs solving.
Yes. So I had to look up the name Tontine. It's an interesting concept. Could you give us a little bit of a background behind Tontine? And as I understand, and as viewers will probably find out after this, a Tontine is a pension scheme, but it's something that has been with us since the 17th century, right?
Yeah. It's you're familiar with annuities. Yeah, it's so an annuity, for anyone that doesn't understand it. They were invented by the Romans, and the idea was that if you're a centurion in the Roman army, when you retire, they'll give you a fixed payment for the rest of your life, for as long as you live. So that was your incentive to fight for the Romans, because of this annuity style pension. So they've existed for 2,000 years, but 400 years ago, the King of France was trying to raise money, and normally they'd do this by selling an annuity that yields, let's say, 6 or 7% per year. And nobody wanted to buy it. Everybody had lots of these in their portfolio. They didn't want to buy any more. And an Italian gentleman called Lorenzo de Tonti came up with a new system. He said, look, instead of paying people 7% for the rest of their life until they pass away, why don't we pay that 7% into a pool and split it between the surviving members? So that, in the first few years, they're all getting 7%. But as members of the tontine start dying off, ultimately the remaining members start getting 7.5, 8, 10, 12, 25, and it just keeps going up and up. And you continue paying until the last of the members passes away. They created this. It was such a roaring success that it spread all over Europe. And every government in Europe was now issuing tontines, because, as Adam Smith explained, it's the fastest possible way to raise capital. If a government needs to raise capital for investment, tontines always raise more money than annuities, and in fact, typically, historically, they'll raise 5 to 6 times more, because with an annuity, you're worried about outliving your money, so you want to have that lifetime income. In a tontine, you're betting on the fact that you're going to outlive everybody else, and that means that you're not only going to have a lifetime income, but you're going to, if you live very long time, it's almost as if you won the pensions lottery. So they're very appealing products.
Yes, when I read about tontines, I thought about the reverse Hunger Games, in a sense, right? It's kind of a survival game in the sense that you get into the pool and then you try to outlive everybody else, and and that's how you kind of win. And I understand that in the structure, it's not the last man standing that wins, but let's say if you started with 10,000 and then the number went to 100, and those 100 kind of win the lottery, then the tontine, basically the structure dissolves. Is that the way it works?
Yeah, more or less,
Okay.
The idea is that if in 2017 there was a study done by 100 insurers and financial institutions, and they couldn't understand why people weren't buying more annuities. And there was a whole section of the report saying, well, look, what do consumers really want? And what they said is that consumers want a lifetime income that can never run out, so that they never have to worry about living on cat food in their 90s. But they want it to rise faster than inflation because, inflation happens, it's inevitable, and you don't want your purchasing power to be destroyed over time. They want low fees, they want it simple. And the insurance industry said, look, this is impossible. We can't create this. But what they actually meant was, we cannot make a high profit offering such a product, which is a very different conclusion. So the tontine, what we've done is we've taken the tontine concept and we've redesigned it so that it delivers exactly what the consumers want. So the money can never run out. And because, two things in life are guaranteed, death and taxes, because you're in a closed pool with 10,000 members and the members are dying off gradually over time, that creates the release of capital that gets shared with the other members that drives the income up faster than inflation. So we found a safe, trusted version that can offer this perfect product at an incredibly low cost without the costs of an insurance company being involved.
Interesting. And I think one of the interesting and very fundamental ways that you guys solve the tontine structure solves the longevity or problem is by pooling that risk together and then rewarding others is quite I would say innovative, but I can't use that word because it's existed for such a long time. Which brings me to my question: why did they go away?
So when they were invented before the time of government bonds and before the time of central banks. And politicians European politicians loved issuing tontines because it allowed them to raise huge amounts of capital, which they could, spend on stimulus, if you want to think about it in modern terms. So they were extremely popular and politicians loved doing it. But the politicians weren't taking into account that they were committing the government to pay these payments, for maybe up to 90 years long. And eventually someone realized, actually it's cheaper if we just issue bonds where we can redeem them later. So ultimately tontines got phased out because they were too good for consumers. The incentives for consumers were too generous and they switched to bonds. In the US, almost would have been 100 years later, the insurance industry, Equitable Life was having trouble selling annuities. Because people hate annuities, they always have, because the value of your purchasing power goes down. And Equitable Life introduced tontine pensions in the US. And these were so successful, they were replicated by the whole insurance industry. And the insurance industry grew by 600% within a generation. Basically, it went from 0 tontines in the US to over half of US households were now invested in tontines. And the tontines created held 7.5% of national wealth. But the problem when you have such runaway successes as this is that the insurance companies got greedy. I've heard stories comparing them to robber barons, but essentially what they were doing was they were taking the capital of the consumers, investing it in their own private projects, charging all sorts of fees and extracting it from the returns. So the returns were less than they should have been, even though they were much, much better than annuities. Basically they just became absolutely corrupt, and they were, bribing politicians. And all of this was discovered in 1905. There was a huge investigation in New York. It was called the Armstrong Commission, and they found out about all this fraud. and they said to the insurance companies, look, if you want to continue offering tontine pensions, you kind of have to do it honestly. You have to treat the consumers fairly. And the insurance companies worked out, well, if we did that, we can't make any money. We'd rather switch to selling annuities, and they did. So en masse, the insurance industry took away their tontine policies and switched everybody to start investing in annuities instead. And to a large extent, tontines haven't really been seen since.
I see. And that's interesting. And I think the way that I've, understand tontines at this point is that it's a savings account, or, that could be opened at any point. Was that right? Or savings or an investment account? Well, let me just ask you this question. How would you describe the experience of an end user on your platform? Let's take your product. And, I am somebody who is in, somebody who's in their 40s, can I use it? How would it work? How would it work? Can you walk us through the steps?
Yeah, well, we're in the process. We're in the final steps of getting approved to offer the product in 27 countries in Europe. Okay. We're waiting on, actually, it's just the tax office approval we're waiting on right now. Once we have that, then we can roll it out. And really, the thing about tontines is that they're a universal product. For young savers that want to save, and for when they retire in 40 years, they can save a little bit every month, as they like. We can do the Acorns model where they're taking, 2% of their expenditure and it's going into their tontine pension account. Or you have this other thing where you've got 75 million Europeans retiring in the next decade. They've been saving all their life into these drawdown pensions, but now they've reached this milestone where 84% of these consumers, they don't want to spend every day watching CNBC, worrying about the price of equities and bonds and interest rates. What they really want to do is relax and enjoy their lives and collect an income every month. And they want that income to rise faster than inflation so that they never have to worry about the loss of purchasing power. So our job is to offer them a simple, safe solution where they can open an account as if it was just a digital banking account. They can calculate how much income they'd like to have in retirement, and they can see what the expected rate of growth of that income is. And then they can just make a deposit and immediately start receiving an income for the rest of their life.
I see. And that inflation rate that you assume, let's say that, I'm a retiree, right? I have $1 million, let's say. I bring that money and I, try to put it in the account, and the account tells me, hey, the rate of growth is X. Now, is that rate of growth purely calculated on the investment returns, or does it include the mortality rate that you guys have assumed?
Yeah, exactly. So great question. So initially, let's say you're 65 today. You deposit €1 million onto the platform. The portfolio that will be deployed into, typically we're targeting a gross return of around 4.5% or net return of 3.5% after all fees have been taken into account. So it's not DeFi where we can go for 10, 12 or anything like that. We're a little bit more boring than that.
You have to be risk averse, I understand.
Yeah. All we want to do is you want to stay ahead of inflation. That's the most important thing. So initially the payment that you're receiving is comprised of that 3.5% per year, plus a slice of the capital. So you're getting some of your capital back at the same time. So let's say you're getting around 4.5% of the year, per year at age 65. But year by year, because you're in a closed pool with 10,000 other guys, the number of members in that pool is falling. And the rule of a tontine is, if you're dead, you don't need the money. So by age 75, let's say we're down to 8,000 members and they have a shorter remaining lifespan, the algo has already increased the payment from 4,500 a month, from 3,500 a month up to somewhere around 5,000 a month. By age 85, maybe we're down to 5,000 members. Again, 5,000 don't need the money, and 5,000 have a much shorter remaining life. So at this point, the algo has worked out that it can increase your monthly payments to 10,000 a month. And now, when Umed takes care of himself and lives into his 90s, which 33% of 65-year-olds will, the algo is pushing that money out the door because realistically, the members are only going to survive another 10 years. We're probably down to the last 1,000 to 2,000 members. And we've got to return all that money to them while they're still alive. So now you could be getting 20, 30,000 a month. So this is why we compare it to, it's like winning the pensions lottery.
Yeah, I mean, it's a very it has a very calming effect, even to me, to be honest. I'm not anywhere close to the retirement age, but I would love to have a product like that, which gives me a peace of mind. And here's how I would play it out. And you listen, here's how I would do it, and tell me if this system could be gamed, right? So if I am at age of 65, right, instead of going into the tontine with the full amount of my needs, I would just basically tailor that. Let's say to live comfortably for the first 5 years, I would need, let's say, $5,000 of income, net income, and let's just basically assume that in order to get that, I need I don't know, you just make up a number like 800
1.5 million.
1.5 million, right? But instead of putting in 1.5 million, I'm going to say, I'm actually going to outlive these guys. So I'm just going to put 1 million, and that $500,000, I'm just going to keep somewhere else. So I don't have to risk losing it if I die to somebody else.
But Umed, if you're dead, you don't need the money.
Well, how about my family, right? So that's a question I wanted to ask.
1 second, the line froze there for a second, so I lost you.
Yeah, I got you back. Okay, so Tontines basically says, if you're dead, you don't need the money, which makes it could make the retirees think about, okay, how much do I think I can put in? And if I need 5,000, I'm just going to put in amount of money that will generate 3,000 for me, and I will put the other part of my money that would supplement that in a place where I don't have to lose it. And then as the time goes by and I'm surviving, I will get to that 5,000, let's say in 5 years. And then that other money that I could have put into tontines to get my first 5,000 immediately, that basically goes back to my, children or whoever, my grandkids or whatnot. Is that something that could be done? Or
that's one way to play it. But let's assuming you've got kids and grandchildren. But so everybody I talk to says, oh, but we put our money in. If we die, we lose it. Well, if you're dead, you don't need the money. But if you've got kids, then we understand that. But if you think about the world we live in now, if you're retiring at 65, you've got $1 million. You have, if you're a man, you have a 33% chance of living into your 90s. If you're a lady, you have a 43% chance. And if you live into your 90s, 1 million is not enough. If you die earlier, then 1 million is plenty. But if you live into your 90s, it's nowhere near enough. Actually, you probably need about 5 million. So this is the problem. Everybody assumes that they have too much money going into retirement. Yep. But if you read all the papers, they'll tell you people aren't saving enough. People haven't realized they're going to live a very long time. And that's a change in mentality we need to bring about, that when people actually run the numbers, and you'll be able to see it in our user interface, that you can see how much money you really need to survive on, taking into account inflation and everything else. So what happens is that everybody says to me, oh, but if I put the money in, what about the kids? So the best example I'll give you is there's a managing director of Deutsche Bank that I was talking to again yesterday, and he made it perfect for me. He said, look, so if I retire with 4 million, he said, I've got 2 kids, I've got a wife and 2 kids. He said, I can stick $1 million into my tontine for me, $1 million in for the wife, and I could give $1 million each to the kids now. He said, and that way I've got income for life. I never have to worry about running out of money. My wife has the same, and the kids get to use that capital now. Now, the alternative to that is that he holds on to the money. He's going to live into his, he's a good chance of living into his 90s. She's most likely going to live into her 90s, in which case that 4 million is not enough. It's not going to be enough to last them. And the kids are not going to get anything. And if they get anything at all, it's when their parents pass away in their 90s, at which point the kids are now in their 70s. So that doesn't help anybody. The tontine allows you to bring forward that bequest, because you don't need to hold the money just in case. Because in case you live longer, you're going to inherit the money of all the other tontine members. So that's taken care of. But now it enables you to give the money to your kids now, so they can buy a house, start a business, or invest in or Bitcoin.
ADA would be my choice. Thank you for answering that question. The next question I wanted to ask is how are the tontines structured, right? So in the case of annuities, we have an insurance company that is selling those. They have actuarials working, actuaries working, trying to figure out who lives on, to what age, and then they give you a number. They say, okay, this is how much we give you when you retire, or if you bring in the money, this is how much income fixed you will have, or variable income you will have. But those two products in particular, one basically has an inflation risk, the second has an investment risk. And, so in terms of tontines, how does it work? Are you guys going to be an insurance company, or is it legally classified as something else?
So we're a pensions firm. Yeah, we've established with a pension trustee business in Ireland. We have a pension administration business in Ireland. But to go back to explain, I think if we can create a simple explanation of how the insurance business works at the moment. Essentially, you go to them with your $1 million. The actuary is going to work out, well, on average, we expect a med to survive somewhere 85 or 92 or something like this. They're saying, okay, and we can invest this money. We can only really invest it in government bonds, which are currently yielding almost zero. And we need a profit margin because we're a for-profit, insurance company. So what they'll do is you give them your $1 million. I think research has shown that off the top, they'll basically take 30% of that as a profit margin up front. The 700,000 gets invested into bonds, and they will pay you a yield, which is equivalent to that bond yield less an ongoing management charge. But the returns are so low. If you look at the returns on offer at the moment, I think you need to live into your 90s to break even, to get your money back. And that's a big sacrifice. If you're 65 now and you're going to hand away your $1 million, and you need to live into your 90s just to break even, that doesn't seem like a very fair deal. And then what happens is that if you think about, for men, 66% of these men are going to pass away before they're 90. So there's going to be money left over if you want to think about it like that. And that money gets paid to the shareholders of the insurance company. That's another profit for the shareholders of the insurance company. In the tontine, there's no 30% upfront charge, and we can invest in a diversified portfolio that gets a 4.5% return. And the effect of this, of much lower fees and better returns, is that your break even is now about, by age 75, 78, or 80, you've already received all your money back, and everything after that is pure profit. Anyone that passes away early, their money, instead of getting paid to us or to an insurance company, that stays in the pool and gets shared with the other members. So essentially, it's a trust. It's a trust managed by trustees that are taking care of the money and passing it out to the members every month. There's no conflict of interest. We can't earn anything except the 1% fees that we charge on the assets of the customers. If you think about what's the risk, for example, if an insurance company goes bust, which they do, especially those in the annuity industry, you're just a creditor. you're in with everybody else, fighting to get some sort of claim on that. In a trust business, there's no leverage. There's, the assets are just sitting there, taken care of by the trustees. There's no debt. So they just pay it out for the rest of your life. So with an insurance company, you have counterparty exposure risk, whereas in the tontine, you just have a share in a trust that's going to pay you income for the rest of your life. It's much, much safer.
Yes, that's an interesting revelation, actually. Dean, I wanted to kind of drill down into the investment portfolio side a little bit here. What would you say is the typical portfolio allocation and the time horizon and the risk tolerance of a portfolio of a, let's say the cohort of 10,000 that just started age 65?
Age 65. So the trick is, my background is investment banking. So I kind of understand financial markets, but I'm absolutely terrified. I don't know. I think, Ahmed, you watch Real Vision, yeah?
Yes.
Yeah. So, it's the top investment experts in the world. And for me, it's a horror show because they scare me to death. Because, who knows where the markets are going to go. The only way to be safe with an investment portfolio is to diversify across different asset classes. Bonds, equities and bonds is not diversification. You need to hold gold, you need hard assets, infrastructure projects that, are crucial to the running of countries and that are going to be around for a very long time. You need to invest for the long term. And I guess the best way to think about the underlying portfolio is to think about as if it was a sovereign wealth fund or a foundation. Typical investment funds or pension funds, they have to have daily liquidity because you could withdraw your money from that account on a daily basis. So they're forced to invest in ETFs. They're forced to invest in equity ETFs, which are extremely volatile. But if you have a foundation that can invest with a 10, 20, 30-year time horizon, now they can buy infrastructure assets and collect the dividends, for a whole generation. So it's much more like that we need to have a very broad spread of stable assets. Like we will still have equities, we will still have bonds, but the point is lower the risk and look for income and, inflation-proof returns rather than gambling. Because we don't need to gamble because you're already getting the returns from the mortality. Yeah, the excess return from the mortality. Because we're not all going to live to 100. We want to, and we want to win the pensions lottery, but we're not all going to. And that is a source of excess return. I think there was an article in the Wall Street Journal Market Watch column describing tontines as the only asset class in the world that gives you guaranteed alpha over all the others through mortality credits. Because you have an excess return on top of the normal market returns, if that makes any sense.
No, that absolutely makes sense. But it doesn't quite. It doesn't eliminate the market risk, the investment risk. It just augments it by the mortality of other people. So the more people, in short, the more people die, the higher your income becomes. So it's supported by that mortality rate. And I going into this, you could be okay if your alternative is running out of money. Contins is your a go-to choice, pretty much, I think, because that takes that huge problem out of the equation, it looks like. And so I wanted to basically go into this other question: who manages the funds? Is it going to be managers that you hire, or is it going to be your trust? How are these decisions made?
So under European law, as a pensions firm, we're required to hire qualified fund managers to do it. And typically we work with the biggest names around. I don't necessarily want to say who at the moment because we're negotiating fees. Their fee expectations are a little bit higher than we want our members to suffer. So we're still negotiating, but we have some very well-known institutional managers that will be responsible for managing the money underneath. the portfolio. And our job is just to select them and get the best possible deal for our members.
That's perfect. And if we can go back to the legal status of tontines, where are you standing right now with regards to that? You said 20 countries.
Well, in 1906, the New York regulator, whose name I can't remember, basically said it's illegal to defraud members of a tontine. Yeah, which, you know, I don't think anybody disagrees with. You know, it should be illegal to defraud your customers, full stop. So there's nothing illegal about tontines in the slightest. There's been many papers written on this, but you know, there's been let's call it a fake news narrative that the insurance companies had to cover up why they switched away from selling tontines to annuities. And this narrative has just evolved, but we've been steadily chipping away at that. Over the last few years, you've seen the UK pass laws enabling these collective risk-sharing pensions, such as tontines or CDCs, and they want to encourage it in the UK. Now, Europe has spent years passing a law, despite the protestations of the insurance companies, to enable low-fee, transparent, risk-sharing, tontine-style pan-European pensions. So now it's possible to create a tontine pension that offers lifetime income and immediately offer it to 27 different countries from your jurisdiction. To the extent that anybody has any doubts about how legal a tontine is, you just need to go and read the OECD Future of Pensions report that was published in December. The report is, it's not for our consumption. It's a guidance note to the 37 member states of the OECD, talking about where pensions are, where they're going. And this edition, Chapter 6, is all devoted to collective risk-sharing schemes such as tontines, or it calls them tontines, annuities. And the conclusion of this report is that they're safer for governments, they're safer for corporations, they're safer for savers. And because of the benefits of risk sharing, that you don't need to hold money back, they enable higher incomes in retirement for everybody. So if the OECD is coming out saying, these are the way to go, I'm pretty certain that means that they're absolutely crystal clear, legal, and recommended.
I see. Now, no, that's fascinating. And one of the things that pops into my mind when I hear these kind of new sort of instruments is about the risks. It's almost sounds too good to be true. Is there any risks and cons that we haven't covered with this structure?
But it's a couple of ways to think about that. So if you think about risk at the moment, if you go into retirement, and let's talk in the fiat world rather than in the crypto world for now. If 100% of your portfolio is invested in your favorite stock, Tesla, that could work out really well, but it's extremely risky at the same time. So that immediately by splitting it between Tesla and Apple, let's say you've already reduced your risk. And the more you can diversify that risk, the lower your overall risk is. At the moment, what's happening is that everybody's going into retirement and with a single longevity risk. It's all about how long you're going to live. So the moment you join a tontine, even if it's only a tontine of 2, you've immediately lowered your longevity risk. So your retirement is now safer. And by the time you've invested in a pool with 10,000 other members, now it's substantially safer. So it's the same process. Tontines are a lower risk solution. If you read the OECD report, which is on our website, you can see it's a lower risk solution that enables higher incomes in retirement. But for those that haven't read the OECD report, that don't know about this, when they come to us, they're like, this looks too good to be true. It's how come the insurance industry can't do this? And it's like, we try to explain, well, because they take a lot of fees out. They don't pay the profits to the members, they pay it to their shareholders. And I've even been at conferences where it's saying, This sounds a little like a Ponzi scheme. But one of the conferences I was at there was a Nobel Prize winning economist at it, and I explained it to him just before he went on stage, and he was so excited. He basically said, look, it's a pension system for the world that can never go bankrupt, and this is the solution to the US Social Security Ponzi scheme that's currently in operation. And what he meant by that is that 49 of the 50 state pension systems in the US, they're using the money of young civil servants to pay to older civil servants that are already in retirement. And the number of younger civil servants is getting smaller every year, and the number of older civil servants receiving money is getting bigger every year. So if you read the reports, they're projecting that these 49 states their pensions will run out, they will collapse within 7 to 15 years. Only one pension in the US, only one state pension is fully funded, and that's in the state of Wisconsin. And the reason that it's fully funded and it's the safest pension is that they run it like a tontine. If people are living longer, then the future returns are going to be a little bit lower. If investments are not performing the way they expect, returns will be a little bit lower. If we're in a high inflation environment, then investment returns will probably increase. If there's coronavirus come along that wipe out half the state, then again, returns will increase. So they pass through all the benefits to the members, all the benefits and the losses. And that's why they can ensure that they remain 100% fully funded. So essentially, tontines are the solution to the Ponzi scheme pension systems that are being operated around the world. And everybody needs to move to this model, which is exactly what the OECD report says.
Absolutely. That's a very interesting piece of information that you provided there, actually. And I would like to ask you one other question, because you were talking about the tontines, and this kind of popped into my mind, and I read it somewhere in an article. If I am somebody with a pre-existing condition, I know I don't have a lot of years life.
You look good to me, Ahmed.
Yeah, no, I'm saying hypothetically, if there's somebody who is with the pre-existing condition, in a world where tontines are a scheme that is not obligatory, but something that you opt into, do you run a risk of having only the really healthiest and really the guys who live very long in the pool, and thereby the longevity, the mortality risk not providing the type of juice that you thought it would provide in your initial calculations?
Well, actually, we factored this in. Because statistically speaking, if you join a tontine, you're more likely to live longer now. And we've been working to understand why that is the case. But if you think about it, many retirees spend every day worrying about money. That's stress. You don't need that stress. If you eliminate that stress, you can relax. And, that's good for your heart. It's good for your health. And if you know that your income is going to rise in the future and substantially later on, you're going to start taking better care of yourself, because now, instead of fearing living longer, you want to live longer. So we have to factor that into the models. We expect that the longevity of our members is going to improve over time. If you've got a pre-existing condition, and you've a life expectancy of 6 months, then probably you can go and do a deal with an insurance company.
Yeah.
But that's not our market. We're focused on the majority of the population. The 84% of consumers that want a lifetime income product. We're there for them, not for the fringe cases. And even as people say, well, I'm a smoker. Do I get a higher return than anybody else? It was like, okay, but if we agree to give you a higher return, do you promise to continue smoking 40 cigarettes a day? And how are you going to prove that? Because the moment you're in, you have a massive financial incentive to start taking better care of your health. So we don't make exceptions for that. It's all about age, gender, where you live, and a number of other factors that we calculate what the returns are.
In that article that you shared with me, Dean, I wanted to kind of, go a little bit deeper into this. the article that you shared with me about this Dutch pension fund, you said,
Yeah.
they factored in an annuity factor, that if your life expectancy is lower, you get paid more in the initial years. Is that something that you are employing, or is it something completely, different, or everybody has the same kind of annuity factor?
So that's essentially that's what we're talking about here. We have been campaigning against the incumbents because we feel it needs to be made fair. And they're saying, well, if we decide you deserve more, we'll give you more. But nobody knows what's fair. Nobody knows, is he a smoker? Is he really a smoker? Does he have higher risk? Nobody knows that. So in our product, it's everybody's treated equally. But you're treated equally with people your age, your gender. We don't put you in with 20-year-olds. We certainly don't put you in with, women of your age, because frankly, they're probably going to outlive you. And you then, if we did that, if we mixed everybody and kept everybody mixed, you have to trust us that we see the future and we can predict the future better than anybody else in the world ever has in history. And we don't believe that we can do that. So the only way to keep it fair is to keep all the 40-year-old guys in one pool, all the 50-year-old guys in another pool, the 40-year-old women in another pool, the 50-year-old men in another pool. And keep it all separate, because then it's always fair, because you're in with people that have the same risk as you. And the whole industry, including APG that you just mentioned, have been arguing against this. And funny enough, I'll go back to it again, the OECD report comes out in December and says, look, these systems, they need to be provably fair. You need to be able to demonstrate how the risk is allocated. You need to prove how you know it's fair, and you need to keep it simple so that consumers can understand it. And the simple answer to that is do exactly what I just said. Segregate out all of the pools and create this Hunger Games of pensions version, which is what we're deploying this year.
Perfect. Now, if you allow me, if you have any other things to say about the structure of Tontines, but I think we've covered in detail for our viewers and listeners about how this structure works. I would like to go into the technology part, which is, something that you and I, coming from finance, we share that. It looks like it's going to be an interesting conversation. So why did you choose Haskell? That's something that's
I'm going to drink some coffee before I do this. Yeah, I was worried you were going to ask. So why Haskell? Okay, so I'm reasonably technical. I think less technical than you, Ahmed. But a few years ago, we were looking at, okay, we need to build this system. We need to make it highly adaptable, highly safe, and impossible to hack, because you don't want to reveal the identity of the members, for example. And we were introduced to Haskell, and it just makes absolute sense. The beauty of these functional programming languages is that the code is more concise and more elegant in terms of how it's all structured with the type system. So essentially what it means that, especially as a startup, you start building a system, you're 2 years in, 5 years in, and you realize, okay, this would have been easier if we had have thought of that 3 years ago. And so you're building all these workarounds and all this additional functionality to handle something that you hadn't realized 3 years ago. And the way to solve this in software is that you refactor the code. You say, okay, you know what? That foundational element of the system, there was a better way to do that. But developers are terrified of refactoring code because it breaks everything. All the little workarounds that have developed over the last few years are going to break if you change this foundational stone in the software. Haskell is built to solve this because essentially, if there's a major problem, you can just go back and refactor the type and fix it at the type level. And the system, to a large extent, this is overgeneralizing. If there are any bugs created by that refactoring, you'll probably find it at the first run. So it's very easy to go back and reimagine the code and refactor the code and keep it clean and lean as you go forward. So now think about that as a global financial institution, which we expect to be in the coming years. We're going to be adding different countries, different functionality. We're supporting different institutions, tax systems. It's going to get extremely complex. but our code is going to be elegant, reliable code that can easily be kept simple going forward, rather than this, this crazy, billion line system, which becomes impossible to change later. So we think that Haskell gives us an advantage over the rest of the industry, because at some point they'll come after us and they'll want to start replicating it, but they won't build a system from scratch. They'll start adapting their systems, and their systems, the developers that are working on them are already spending 80 or 90% of their time worrying about, breaking the code. Whereas Haskell, in functional programming languages, you're spending 80% of the time adding new functionality. And that's a huge difference. So we think that, for large scale, institutions going forward, Haskell is the safer way to go. And the other thing is that, because it's provably safe, the chances of us getting, what was the polka dot kid a few years ago, 3 years ago, I killed it. He killed 300 million. Because they hadn't investigated this edge case. Haskell kind of, to a degree, limits the need to worry about edge cases. So it's definitely, as far as we're concerned, the language of the future for large scale systems.
Oh, it definitely. I can attest to that as a pool operator in Cardano. We had a testnet written in Rust. And it was bumpy, especially in the beginning. And the moment we switched to Haskell, I was all ready to pull all-nighters and try to watch my node, make sure that it all runs. It just simply ran. I mean, I had so much pent-up anxiety for the testnet in Haskell. We had a testnet in Haskell that I expected that the node would break down and it would just. In fact, I never had to switch off my servers or do anything. It just worked, and that was the magic of Haskell. And I'm quite convinced that it's a really, really stable, really well thought out language that is needed for cases like where you have a high stake, whether it's be money or lives. At stake. So I'm glad that you mentioned these sort of reasoning behind choosing Haskell. It's an amazing sort of language that I have come to be to respect and love. Now, you mentioned blockchain in our conversation before. Are you using blockchain in your products?
Yeah. So it was funny when we started out, so I got exposed to Bitcoin through John McClelland before he set up the Bitcoin Foundation back in 2011. And I completely got it. And I was so excited. I said, look, if this is the future of money, let's become the Goldman Sachs of Bitcoin. And I spent months looking at it. I just thought, it's too early. There isn't enough people in the system. But obviously, I kept track of everything that was going on. And when I was researching the whole retirement problem and the suggested solution for tontines, it was like, I said, okay, so we need to create a pension system where you know exactly where the money's going to be invested. So it needs to be transparent. You need to make it impossible to tamper with the membership ledgers. And you need to keep everybody anonymous to each other. And I just thought, oh my God, this is a perfect use case for blockchain. So I got on the phone with John McClelland, and I told him, I said, listen, I found something. I said, I think it's a major global use case. And he said, what is it? I said, you wouldn't understand. He said, just tell me. So I said, look, it's about something called a tontine. And he's like, no way. I won't say the word he did use. He said, look, I know some guys in Berlin. They've been talking for years. If anybody can figure out how to put tontines on a blockchain, it's a multi-trillion-dollar industry. I'm like, yep, this is exactly what I'm talking about. So the way we see it going forward is that right now, if you're saving into a pension scheme in Switzerland, Germany, Spain, or something like that, you don't know where your money's going. You don't know where it's being invested. All you know is that there's a government or whatever, or there's an institution that says, yeah, don't worry, we'll take care of you in 40 years' time. You don't know what fees are being charged. You don't know what risks are being run. And it's intransparent. We have, I think we've already won one award for being the world's first fully transparent pension fund, because what we want to do is we want to make it possible that all the deposits that are coming into the system can be tracked and traced. Where the money is invested, where the assets are held, can all be verified on chain, so that people can see that the money's safe and that the projected future income that we're telling you that we believe you can expect, that these calculations are correct. And I think this is the future of financial services. To be able to have that level of trust is to be able to show people exactly what's going on. And the only thing you need to ensure is that the identity of the members are kept confidential. The members are kept anonymous to each other. So we see this as a major global use case for blockchain. The issue we've got is that introducing people to the concept of tontines is already a challenge. And it's getting much, much easier over the last year, especially now with big institutions coming out. But introducing them to tontines and blockchain at the same time, it's kind of, it's too much for most people to get their heads around. So we deleted the word blockchain from the website to stop distracting people, because people had so many historical hangups about what blockchain is. But ultimately, it's the perfect system for running these rules-based schemes on. It's all just a rules-based scheme, and we want to make sure that nobody can cheat it. I'll give you one quick example. Years ago, there was a UK company, Equitable Life, that offered guaranteed annuities that paid you a certain amount per life. And they realized, as many insurance companies do, we offered too much, we can't afford to do this. They went and changed the rules. They buried the change in this huge document that they submitted to the regulators. I'm not even sure if they disclosed it to their members, but essentially it tweaked the algo so that they no longer offered what they had planned before, and it solved their problems until they were found out. We want to make it impossible for anyone to do that in the tontine industry of the future, so that if anyone tries to change your entitlement, that they would have to touch the code on a public chain, that immediately that would come to everybody's attention. That's the way we see it, and that's the use case for blockchain.
Yes, I mean, you thinking out loud about that. If your contract is at the time of inception captured in on a blockchain, you have no way of changing anything retroactively. That's for sure. Yeah, that's a fascinating sort of angle to explore, and I think in that article that you sent to me about the blockchain, the use case of blockchain for pension schemes. The authors of that article looked at Ethereum, and they came to a conclusion that it was too restricting to actually run the pension scheme completely, in a trustless environment. But these things are changing, and with Cardano, we might be able to accommodate something like that in the future. Do you think about using Cardano as a platform for your services? And it doesn't have to be, by the way, for your clientele. You don't have to say that it's using blockchain. As far as they're concerned, it's another piece of infrastructure. You're providing the interface that is necessary for them to function, and and everything is on the blockchain, which could be good for the regulators because it gives them a peace of mind that everything has been saved.
Yeah, absolutely. So we decided long ago that we didn't trust Ethereum in terms of the way it's programmed. It's not a functionally programmed blockchain. Whereas, if you look at the likes of Cardano, Tezos, and there's a couple of others that do use functional programming languages, we believe they're much safer to build on. I think it's too much of an expectation that we can build and host national pension schemes completely on chain right now, but that's evolving. It's going to get there. The way we see it right now is that we're building the system in Haskell, so it will be easy to port over to a chain like Cardano in the future. But what we can already start doing is creating the transparency layer, so that when we when we start receiving the deposits and investing them at various global custodian banks, instead of you having to trust us that the money's there, we can actually create oracles connected to our accounts at the custodian banks that will expose what the portfolio is. So you can see that the portfolio is growing. You can see what it's invested in. And this is the beginning of making the world's first fully transparent pension fund. And bit by bit, we move all of the functionality on chain. But this is going to happen over the course of years. But if you think about it, the majority, 99.99% of participants in tontines, don't understand blockchain. They don't understand the technology. But the point is that we allow them to pull back the curtain and see what's actually going on, to be able to investigate it. And whether that's media, regulators, financial analysts, or highly technical consumers, they can verify everything. And that's the point. If it's available to be checked, you don't necessarily need to be checking it. Whereas with existing institutions, well, they're 100 years old, so you just got to trust them because they'll do right.
Yeah. No, this conversation actually opens up a lot of questions about, why we trust in institutions and what happens when these institutions, because of the market conditions, fail. I think I read a report or somebody mentioned to me that in Germany, one of the biggest insurance companies decided that the people who got, who were promised, let's say $100 or, $1,000 would get 60% of that during their pension because they miscalculated the inflation risk. So imagine you are somebody who is, retiring today, tomorrow, and then you are going to have 60% less than what you expected. It should be, it's pretty devastating. And the fact that it's legal, you can't do anything. I mean, I'm sure that they're taking that insurance company to the court and whatnot, but it just shows that those risks are not even taken by the company, even though they're supposed to be taken by the company, right?
Yeah, it's guaranteed until it's not.
Yes. So I think what was, if you're a company and you are saying that, if we honor our obligations because we miscalculate the price of inflation, for instance, the inflation rate, if we honor our obligations, we will go bankrupt. Then it becomes an existential issue for the government. And so, they will have to bail you out otherwise. So, it's kind of being between a rock and a hard place. And, you, on the one hand, you can just say to your clients that they're going to get, 40% less of what they were promised and you survive. On the other hand, you go bankrupt and the extreme case, you go bankrupt and the government loses the tax revenues and whatnot. And on the other hand, the government comes in and bails you out. So, but
the government can't bail everybody out. The government pension schemes are already in huge trouble. I think there was a report 2 years ago by Citibank. The top 20 OECD countries had a pensions deficit of $80 trillion, $78 trillion, which was double GDP back then, only a few years ago. But the thing is, the pension deficit is rising much faster than GDP. It'll be 400 trillion by 2050, when the majority of the people watching this are retiring. So there is no government bailout. It's over. So you can't take the risk of giving your retirement funds to a company, an insurance company, where if you look at their balance sheet and look at the balance sheet of Lehman Brothers, you can't tell the difference. The logos are different, but otherwise these are highly leveraged investment vehicles, and they are definitely regulated. But ultimately, they're highly leveraged investment vehicles. And if you're comfortable with that risk, that's one thing.
Yeah. When I think about tontines, one of the other things, and that's kind of one of my last questions here, is their great need in developing countries. We're talking about countries that do not have institutionalized or institutional level pension schemes. Do they have any chance of obtaining or participating in your pension scheme? And what are you guys doing?
It's interesting you say that, because actually there's a lot of new member states of the European Union that don't have personal pension schemes already. Many of these, and this is one of the advantages of the pan-European pension, is that you can now create schemes for all of these countries because they don't have anything they can trust at the moment. So it's not just developing countries, it's developed countries as well. But the way we see it, we've designed the system so that it can scale for any type of country or any transaction size. I was in Bangladesh, I think it was February last year. They want to launch a new pension system, and their current thinking is that they'll copy the pension system of India, which is a drawdown account. You save all your life and then you worry for the rest of your life about how to spend it. And our mission is, look, guys, let's leapfrog you to the future of pensions, to the system that you save and then you get an income for life that rises faster than inflation. So we've designed it in such a way that's scalable to any country. And I have multiple conversations going on with development banks and everyone else to take this, all over the world. I think Cardano has a big focus on Africa. Africa is the market of the future, or the continent of the future. If you think about that, there's no pensions. We could create a supranational pension fund. In fact, we are in talks with one of your former employers, let's just say, about doing work with them to roll out several schemes in countries. Because for us, it's just plug and play. Let's say if you think about Cardano as a financial infrastructure, we're the application layer on top of that, and then it's just about customizing it for each country and rolling it out. So there's no question this will happen. The OECD is pushing the 37 member states to move to this model. Think about all the states that don't have any model, that don't have any pension system at the moment. They can immediately jump ahead of the developed nations by going straight to the next generation of pensions.
That's fascinating. Dean, this was an amazing conversation. I cannot thank you enough for coming on the Slot Leader to share your thoughts and tell us all about the Tontines. It's an amazing scheme. It's an amazing product that everybody needs. And you have found a way to transparently deliver it to those who need it. And I wish you the best of luck. If you have any last words that you would like to share with my audience, this would be the time.
No, well, it's just, I think ultimately, as much as we all want to be crypto billionaires, etc., it's not every one of us is going to be that lucky. So at some point, we all need to start thinking about how we're going to enjoy life when we want to kick back and relax in a few years. Historically, more than half the population is in a tontine. So we see no reason why that's not going to happen again in the future. So whether you like it or not, you're going to be a tontiner at some point in your future. And I think you're gonna love it.
Absolutely. I'm going to start working on it and make sure that I'm healthy, and I like winning,
Exactly. Yeah, absolute pleasure, Ahmet. Happy to continue talking. I think we have a lot of relationships and stuff at a very high level across the world, and definitely let's keep in touch and keep you updated.
This marks the end of our episode today. If you like the type of content that we're putting together, please don't forget to subscribe, like, or comment. And when you do subscribe, don't forget to push that bell button so you get notified the next time we release an episode. And I promise you, as the time goes by, they will get quite interesting. We are entering an era in Cardano where we will see a more robust types of products and very interesting use cases for this project. I'm your host, Umed Saidov, and you've been watching and listening to Slot Leader. I'll see you next time.